Hi, this is Ernie again. I'm that guy who had $6 in his checking account to now having millions of dollars. One of the most common comments that I received was, what exactly is Roth IRA? How do I utilize it? Is it better to invest there versus 401k? I'm not a financial advisor, so I'm not going to tell you exactly what you should do. I'm trying to provide as much information as possible so you make the most informed decision. And I always encourage people to talk to their financial advisor after watching this if you want to take a full advantage of some of the things that I mentioned. So let's talk about difference between traditional IRA and Roth IRA. Traditional IRA could be in multiple forms, right? So you had a 401k account with your previous employer, and when you left, rather than keeping it there, which has very limited investment options, you decide to roll over your 401k into your IRA account, where you could trade options, you could buy individual stocks, and you have a lot more ETFs to choose from. Great. But a lot of the times, the common mistake is that you combine rollover 401k, which is pre-tax money, and you contribute annually. I think this year it was a $7,000 contribution, and depending on your income level, this was tax deductible, whole thing or partially. So there's a tax deductible money, and then if you make over $85,000 or $83,000, none of this money is tax deductible. So it is considered post-tax money. So if you put all three into one account and they grow and they're getting dividends and so forth, it's almost impossible for you to figure out, unless you spend enormous amount of time, which one was pre-tax, which one was tax deductible, and which one was post-tax. If that's the case, and since you have pre-tax money and tax deductible money, when you try to convert them to Roth IRA account, you need to pay capital gains. And some people consider penalty, whatever you want to call it. One way to avoid that is if you separate your accounts into three. So that's the mistake that I made. So when you do this, I want you to have three IRA accounts. One is pre-tax money that you rolled from 401k. Second one is tax deductible IRA account. That's assuming that you make less than $83,000 at some point. The other one is completely post-tax money. And the reason why I'm asking you, I'll explain in just a little bit. When you convert them, in order to avoid paying capital gains, you want to have zero balance in your IRA or tax deductible money by rolling all of that back to your 401k account. So only IRA money that you have is the post-tax money. Then you could use something called backdoor conversion into IRA account without having to pay any capital gains when you do the conversion. Why do you go through this trouble of putting money into Roth IRA? The major benefit, you might hear it from Peter Thiel, having billions of dollars and not having to pay taxes, is any capital gains, any money you make in Roth IRA account, you do not have to pay capital gains. Zero capital gains tax. So if you're young and if you're making less than a certain amount of income, I think it was like $143,000, try to maximize your contribution to Roth IRA because you do not have to pay capital gains tax ever. And any money but in order to do this, again, you need to empty out your pre-tax IRA and tax deductible IRA so that you don't have to pay capital gains. This is the mistake that I made. I ended up having to pay a lot in capital gains. I know this was longer than I intended, but This was the mistake that I made. I hope you guys don't make the same mistake. But if this was too complicated, write comments. I'll try to explain as much as possible. And I'm actually trying to convince one of my buddies from Merrill Lynch to do an interview so that maybe he'll explain better. And you get a free financial advice from a professional who can tell you step by step how to get this done. Hopefully this was useful. Please like, follow, and repost so that other people can take advantage of an amazing product called Roth IRA and not have to pay capital gains tax.